at how two sole traders might join together to form a partnership, we are now going to consider issues such as goodwill, as well as how we will record the transactions if a different forms of business or forms of ownership join together to form a business. To start with, I want you to imagine a situation where you have an existing business, but you've decided you would like to grow it. You can either buy all the assets of Better Business at an agreed price, or you can buy it as a going concern, but then you will pay a higher price. What is firstly meant by a going concern? Do you remember that this means that we expect the business to continue operating for the foreseeable future? In other words, in this case, if you're buying the business as a going concern, you will take over all of the day-to-day activities. You will keep the customers, you will get all the customer details, you will have contact through the suppliers, etc. So you are buying the business and the business will carry on operating day-to-day. It's simply where the ownership or the management has changed. On the other hand, if you simply buy up the assets of the business, it means the business actually shuts down and then you simply incorporate the assets into your business. If you buy it as a going concern rather than just buying the assets, why do you think you might agree to pay more rather than simply buying all of its assets? What are you going to get by buying the entire business as a going concern that you wouldn't otherwise have? Well, as we just mentioned, part of the fact that it's a going concern means that you will benefit from the fact that the customers are already there. You have a loyal customer base, hopefully. You will benefit from the existing brand name and all the existing activities and policies and procedures and so on that are already in place. And so it means that you can actually benefit from that. You don't have to go through all the hard work of setting up the business. Remember that it's a business setup that it's the hardest and most expensive part. And lastly, how do you think this extra value could be recorded in your accounting records? Well, obviously the idea that the business is worth more is rather subjective. So you can't, for example, take an existing business that you own and just thumbsuck the idea that it is worth more than just the assets. That's not allowed. However, if you buy a business and you pay more for it than the value of its actual assets, in this case, you would actually call it goodwill, which is an intangible asset. In other words, it's an asset that you can't see and touch, but it does exist. And because you are actually paying money for it, you are able to show this in your accounting records as an asset. So let's have a look at this idea of goodwill. Where you buy a going concern, it means that you are taking over the entire business, which includes all the assets and all the liabilities, as well as other stuff. So the existing business already has benefits of having made a name for itself, the brand that people might know. It has an existing customer base that hopefully includes loyal customers. It has a good supplier list that you can get decent products from at a decent price, hopefully. And the price that you pay for this going concern will take all of these considerations into account. Where this purchase price is higher than the net asset value, remember that the word net means you're taking something away. So net assets basically means your assets less your liabilities. And before you work that out, remember that you would also be able to revalue all the assets. Maybe you disagree with the value that they have put on the land and buildings or the vehicles, etc. So you would revalue those assets realistically, obviously, subtract any liabilities that must still be paid, and then compare that to the purchase price. If there is a higher price, this extra amount is treated as an extra asset that is paid for, even though you can't see and touch it. And this may be included in the non-current assets of the buying entity, in other words, your business if you are the buyer. This is known as goodwill, and it's an intangible asset, as I mentioned. And it represents the perceived value of the future profits of the business as a result of its already having been established, having a customer base, having a brand name, etc. Goodwill will only arise, it can only be recorded when a business is bought as a going concern, and not if only the assets are purchased and the business itself is closed down. In other words, operations must carry on as normal. The shop won't ever close its doors, other than maybe just for moving stock around or whatever. But it must carry on as normal with its exact name, etc., and keep the same customers if they have accounts and so on. In order to calculate goodwill, as you may have already figured out, you're going to have to look at what the assets are. You're going to firstly revalue them if you don't agree with the values that are existing. Then these realistic values are going to be used in your accounting records to show the revalued amounts. And you will then work out the net asset value, which can be calculated by subtracting the liabilities from those assets, and then you'll compare that to the purchase price. In other words, exactly what I was mentioning up here already. So if the purchase price is higher than the net asset value, the difference is going to be your goodwill. So this is the formula that you will use. Goodwill is going to be the purchase price, what you paid for the business, less the net asset value. And net asset value is your revaluation of your assets minus the liabilities. Well, when I say your assets, I mean your newly purchased, in other words, of the business that is being bought. The new business's assets less its liabilities. At less than it's actually worth, simply because the seller is wanting you to take over those customers and suppliers and maybe employees, etc. And therefore they are happy to sell it for less than it's actually worth in order for the business to continue. In order to record goodwill, basically you've got to show all your assets and liabilities in the new accounting records exactly as we did before, together with the purchase price paid, and then goodwill will actually be the net effect. So if you think of previously, we did it exactly like this, but without the goodwill, where we added the assets and the liabilities of the different sole traders together. In this case, if you are buying a particular sole trader, you would keep it in your records as normal. You would revalue their assets and liabilities and simply add it to your accounts, and the difference between that value and this bank figure will be your goodwill. If the goodwill is a negative as mentioned, it simply means that your goodwill would actually have a credit balance instead of a debit balance. It will be shown on the statement of financial position as it's an asset and non-current asset, and we'll call it intangible as opposed to tangible assets such as property, plant, and equipment. So this is what it would look like. On the statement of financial position, under your big heading of assets, you have a heading of non-current assets, which would include your tangible assets, which is all your property, plant, and equipment. And remember that this would be revalued amounts. And then you would include your intangible assets or your goodwill below that. Let's have a look now how to record different types of amalgamations. So situations where you've got forms of ownership other than just sole traders joining together. Firstly, let's look at a situation where a company buys one or more sole traders. This is an example that I've just mentioned in discussing the goodwill, how you would actually do that, but I've laid it out here for you in a little bit more detail. Where a company buys one or more businesses that are sole traders to start with, it's obviously quite simple because it just means you've got a number of businesses owned only by one person each. And what you will do is you will simply put this transaction into your books, you being the buying company. Similarly to when you added two sole traders together, however, there are some specific differences. Firstly, when your business is buying out another business rather than you're just joining forces, you are only going to revalue the assets of the business that you are buying. You won't revalue your assets at the same time, because all that's happening is you are paying out the other business and incorporating it into yours. They will no longer be owners of the business. Secondly, all the assets and the liabilities of the company that you've bought are going to be added to your assets and liabilities. But notice it's at the revaluation amount. Thirdly, The purchase price must be recorded. In other words, you will reduce your cash, or sometimes what will happen is instead of paying cash, you might decide that you give shares in your company to the old owners of the sole trader, in which case you would increase your share capital by that purchase price. And that would simply be an entry where you would credit capital and then debit all your assets, etc., with that purchase price, instead of crediting bank. Where there is a share premium that is maybe going to be paid for this, you will calculate it as the difference between the purchase price and any cash that was paid plus any share capital. So simply, it means you're working it out as a missing figure. Your cash plus your share capital plus your premium will be the purchase price. Then, lastly, remember you need to include your liabilities taken over when you're calculating your goodwill. So you can't just look at goodwill as your purchase price minus your assets. You've got to first work out your net assets as shown above. So this is how it's actually going to be shown in your journal. Your debits will be all your assets at the revalued price and your goodwill, as we saw on the previous page. Your credits will obviously be your liabilities and your bank, as we saw on the previous page. But if you are issuing shares, it will also be share capital and possibly your share premium. Hopefully now you can see how your share premium might be the missing figure here. You might actually have to work out two things. If they tell you what the purchase price is, your share premium would be the difference between the purchase price, which must be all three of those figures, less these two, the bank and share capital, to get your share premium. If you know your purchase price and you know all your liabilities and you know all your assets, you can also work out your goodwill as a missing figure over here. The accounting records of the sole trader that's been bought will be closed off using a realization account, just like you would have done for the two sole traders that decided to join to form a partnership. And you would close off all the assets and liabilities into this account. But remember, in the sole trader, it will be at the original values. In other words, the values that the sole trader had those assets and liabilities at. You would also show in the realization account the purchase price that your buying company is paying or that the sole trader is receiving, in the case in the form of bank and or shares that might have been given in the company. This profit or loss that is then calculated thereafter, which would in fact be similar to the goodwill, but it might not be exactly the same if your assets have been revalued. Because remember, if the assets are revalued, it means that your assets used here are at a different value. Your profit or loss on the sale is going to be transferred to the capital account, which would then also be closed off against the purchase price. So this is what your realization account will look like. Your assets will obviously all go on the debit side because you would have closed off each asset on the credit side and bring it in here on the debit side. So now you'd have no assets left. The same with the liabilities. In the same way, you would close them off to the credit side of the realization account. And you would then also on the credit side show your bank or the shares in the buying company or whatever as the purchase price over here. You would then be able to work out what the profit or loss on the sale is, and you would transfer that to capital. Over here, because it's on the debit side of the realization account, it means it would go on the credit side of capital. In other words, a profit was made on the sale of the sole trader. However, if you're missing figures on the credit side of the realization account, it simply means that you would transfer it to the debit side of capital. In other words, it's reducing the capital and you made a loss on that sale. The capital account would have had a balance brought down at the beginning, which should obviously be a credit balance. You add or subtract your realization profit or loss, and then the net effect would be the amount of money that you're actually getting from the buying company. And it should all work out. If it doesn't work out, it means that you have made a mistake somewhere. Where a company buys a partnership, it's going to be very similar. So draw on the knowledge of what you've done before. There's just one or two slight changes because obviously in a partnership, you don't only have one person that you're dealing with, you have a couple of partners. So in some ways, it's almost like buying a couple of sole traders, but it's a little bit more complex. Firstly, your assets and liabilities are going to be added onto your company at their revalued amount, as we've done previously. The purchase price paid will be made, obviously, either as cash and or as shares. But now what you have to do here is decide how you will distribute those shares and or cash to the different partners. Obviously, they would have agreed on a profit sharing ratio, and you would need to then pay out the cash and or shares in this particular ratio. In the partnership accounts, they would need to make a realization account, as we did above for the sole trader, and any profit or loss will again be apportioned to the owner's capital accounts, and the amounts paid to or maybe received from them should close off these capital accounts. You might have a situation where a particular partner actually ends up with having to pay out the other partner because they had overdrawn their balances or something like that. So it is possible. Basically, you've just got to make sure that you balance the accounts and they all work out nicely. So what that means is that the realization account of a partnership will look exactly like this, but over here, this capital amount will be divided between the two partners. So you would only have one line here. You would have capital for A and capital for B. And then you would show it into the capital account and you would balance it with the bank amount. Let's now have a look at a situation where a company buys another company. This is also known as amalgamation. So it could also be sometimes referred to as a takeover, where one company buys out another company. You're going to record this very similarly to how you did before. In other words, the assets and the liabilities, including any goodwill that you've paid for, will be added to those of the buying company, and the cash will be paid or the shares will be issued as a payment. However, remember that when we transferred all these things across, let's have a look here quickly at this journal entry. Notice that we transferred assets, goodwill is also an asset, we transferred liabilities. We did not transfer any equity of the company being bought. Notice that although there's share capital and share premium here, this is simply part of the purchase price. We are giving them part of the equity of the buying company. Notice there's no equity of the selling company here, because that will simply in effect be the difference between the assets and the liabilities, in other words, the purchase price. So where we are looking at a situation where one company buys another company, don't let retained earnings or share capital of that company being bought confuse you. Ignore it completely, because we did not deal with equity of the bought company before. We won't do it now either. Okay. The only equity that we need to show is the equity of the existing company that is incorporating the new company. So just like we didn't add capital of the sole trader or the capital of the partners, we are not going to add the share capital of the bought company. Obviously, this scenario is where a company is buying out another company in its entirety. It is, of course, possible for it to buy part of another company, which is what we're going to look at now. Sometimes what will happen is that a company doesn't want to own a company in its entirety, but decides to buy up some shares. Of course, over time, they may end up buying up all the shares, in which case they will then be a wholly controlling company. But let's just look at the partial purchase. What happens over here is if you only want to buy part of the company, you just buy some of the shares. So rather than buying the entire company, you can buy part of the shares, either directly from the company itself, if the company is issuing shares. That would only be if there's a new share issue, obviously. Or if they're not issuing shares, you can buy shares from existing shareholders who decide that they want to sell their shares. This transaction is very simple in both cases. All it involves is a cash payment for those shares, and then you would include the new shares that you've owned as part of your investments under your non-current assets in the statement of financial position. So instead of taking over all the assets and all the liabilities as a going concern, you are simply buying up some shares as an investment. And this would then be shown as part of your financial assets under non-current assets. There'll be no other changes to the buying company's accounting records, so you're not going to change your assets or liabilities. So it's actually very, very simple, but you do need to keep that in mind. And if you do see information about the company that you're buying shares of, if you get information about their assets and liabilities, just ignore them. Keep in mind that control of any other company can be gained by acquiring more than 50% of the shares. So if you own 51% of shares in another company, even though you don't own the entire company, you do actually control it. Because remember that in order to control a company, you as a shareholder have the right to vote at annual general meetings. And your votes will determine what the directors can or cannot do. And in that way, you are able to control the activities of the other company that you are controlling. Because of that majority vote, and as a result you can then control the decision making. We will refer to a controlling company as a holding company. A holding company simply means that they own most of the shares and are able therefore to be able to vote and control the decisions. And the company that is being controlled is known as the subsidiary. And a wholly owned subsidiary is where all the shares are owned by one company. In other words, it owns 100%